Hi everyone, welcome back to my channel. So today's video is all about Roth IRAs versus traditional IRAs. So I'll cover the tax trade-offs, I'll also discuss some of the contribution rules and limits, and we'll take a look at some of the RMD rules with withdrawals, account restrictions, and then of course lastly we'll talk about the pros and cons of the major takeaways. So let's get right into it. Y'all can see here I'm on Vanguard's website, and of course I had to go straight to the source so that y'all have all the information that is current and updated. And the reason I chose Vanguard is because they're a trusted corporation. So of course the reliability of this information and their offerings is valid and trustworthy. So getting started here, you can see I have the IRA eligibility, and it's just discussing the details of what it takes to be eligible in order to qualify for these types of accounts. Now real quick, to go ahead and define both of them, the major difference is that a Roth IRA is going to account for contributions that are made with after-tax dollars. And it's also going to have qualified withdrawals in retirement, and this is going to be tax-free. So you'll look at this as principal plus gains, which are subject to the rules that we'll discuss. Now, a Roth IRA is best when you expect higher tax rates later, or if you want tax-free growth on your money. A traditional IRA, on the other hand, contributions may be tax deductible now, and it just depends on income and access to employer plans. So withdrawals in retirement are taxed as ordinary income. So this is best when you want lower taxable income today and you expect lower tax rates later down the line. Now, some of the pros of a Roth IRA real quick are going to be, of course, the tax-free withdrawals in retirement, which is big because of the long-term compounding of growth. And with there being no taxes on qualified gains, this is ideal for high-income strategies because it's a concentrated way of growing your money over time. And with the Roth IRA, there is some flexibility for withdrawals, and we'll talk a little bit more about that in a second. But you can withdraw your contributions, not necessarily the earnings, but it can be penalty-free and tax-free in most cases, and this is useful for liquidity. But you definitely want to use this with caution because rules, of course, will always come into play. Now, there's also specifications for RMDs with Roth IRAs because they do not force any type of required minimum distributions during the owner's lifetime, and that's good for legacy planning. Now, on the other hand, a couple cons for some Roth IRAs that some may view are going to be the limits plus the income phase outs. Because high earners may be phased out of direct contributions, there are workarounds in some cases, but they add a little layer of complexity. There's also no immediate tax deduction, and this is a little bit less attractive if you need to reduce current taxable income. Now, with traditional IRAs, on the other hand, you're more than likely going to be tax deducted now in most cases, and contributions may lower your taxable income today if you qualify, which can be powerful for tax planning. Now, traditional IRAs are good for high income years where you want immediate tax relief. But the drawbacks to this are going to be the withdrawals that are later taxed at ordinary income rates. And that includes both original deductible contributions and earnings. And then also RMDs start at a required age. And that's just simply because rules change. So RMD age rules and timing matter. So that's essentially the main things to keep in mind. But I'm going to go ahead and scroll down so we can get a little bit more information. We're going to see here some Q&A questions that they have. And again, you can find this website here. You see the link for it. But essentially all you're going to type in is just Roth IRA versus traditional, and it'll give you this information. So it goes on to mention the income limits for IRA contributions. In 2025, single filers cannot go above $150,000, and then married couples are limited at $236,000. Now, an IRA, on the other hand, is telling us here that it's available for anyone. Now, the contribution limit, they have it set up where you can't exceed your earned income, so definitely keep that in mind. Because contribution limits are indexed and they change periodically, so you always want to confirm the current year's numbers before making any major decisions. Now, underneath that, you're going to see specifically where it's discussing income and how it affects any type of contribution. In earnings withdrawn tax-free only if the account is at least 5 years old and you meet an exception. So it could be anything for age, first-time home purchase up to $10,000, or a couple other major factors as well. But an important thing to note is that it could be reduced or even eliminated based upon your modified adjusted gross income. So this is a key factor to always be aware of. Now, with the traditional IRAs, distributions before the age 59 and a half, they typically incur a 10% early distribution penalty plus income tax. unless you meet an exception, of course. So the main point here is that Roth conversions have their own timing and tax implications. While converting to a traditional, this is going to generate taxable income in the conversion year, and it must be planned around your own tax situation. So scrolling down, they're also talking about, of course, minors and whether or not they can contribute to an IRA. And the answer, of course, is yes. But in both cases, the IRA must be controlled by a parent or guardian until the minor reaches typically 18 or 21. And it's all going to be based upon the minor's income, not necessarily the parent. Now, this sparks the conversation around required minimum distributions, which are those RMDs. So the main thing to note on this is that with Roth IRAs, if you're the owner, you typically do not have RMDs during the original lifetime, and that's a major estate planning benefit. But with traditional IRAs, they do require RMDs beginning at a specified age. It could be for current guidance, the first RMD in the year you turn like 73, for example, and you can check any type of current rules as they change. Now, scrolling down, you can see where it's also talking about non-working spouses with the contributions to IRAs. For the most part, you'll see the similarities here. And then scrolling down is also discussing the contribution rules. Now, this is where it gets a little more specific on exactly how you'll go about understanding this information. So again, if you're under the age 50, you can contribute up to $7,000 with your Roth IRA. If you're 50 or older, you can contribute up to $8,000. Now, on the traditional side, if you're under the age of 50, kind of same thing, 7,000, 50 and over, 8,000. And then scrolling down is also presenting the question on whether or not you can claim these contributions as a deduction on your tax return. And the answer is yes and no. So yes, of course, you can do it with a traditional IRA, but no, contributions are not deductible if you're looking at a Roth IRA. Now, on the traditional side, you can typically use the tax deduction to reduce your taxable income. So this is a pro in a sense, but keep in mind there can be a limitation on the deductibility if your spouse is already covered through a retirement plan. And then scrolling down, it's talking about the deadline, of course, April 15th on both sides, so it's cohesive. And then underneath that, it's also mentioning the amount that you need in order to open an IRA account with Vanguard. And standard across the board is $1,000, while other accounts, on the other hand, require at least a $3,000 minimum. Now, when we get into the withdrawal rules, there are some differences here. For the most part, the main difference is going to be on the taxes that you'll pay. With the Roth, you don't pay taxes on withdrawals. With the traditional, you pay ordinary income tax on the withdrawals. Now, when we take a look at the restrictive age for it, there are no penalties on the withdrawals for the Roth IRA, even if it's taken before the age 59 and a half. But on the other side, there's a 10% federal penalty tax on those withdrawals. So this is why it's always best to pre-plan as far as what you feel your decision making will be in the long term. And then scrolling down, we take a look at the RMDs. The Roth IRAs have no RMDs during your lifetime, but traditional ones do have some federal laws that you definitely want to take into account. And then scrolling down, you're also going to see where it talks about which one is going to be the best option for you. Now, obviously, this is going to be dependent upon your future financial planning on what you feel is going to be best. So definitely consider your future income levels, your age and your retirement timeline, tax filing status, and of course, your financial needs. And essentially, those are going to be the main things to consider. All right, y'all. So this was just a brief introduction, just introducing the main things that you would need when you're planning for your retirement. So I hope you found some value in this information. And with that being said, that'll just about do it for this video. So if you did find any of this information to be helpful, of course, feel free to leave me a comment down below. As always, I thank y'all so much for watching. And of course, I'll see y'all in my next one.